a question people have asked me in the comments a couple dozen times is, hey Azul, can you explain to us why when inflation goes up, stock prices generally go down? Why is inflation so bad for stocks? So let's go for a walk and talk about it. And you know, I think it all comes down to a battle between Tina and Tammy. And no, those are not my sister's name, nor are they my daughter's name. Tina is an acronym, and it stands for There Is No Alternative, TINA. And when you think back to not that long ago when interest rates were almost non-existent, you know, where else were you going to put your money, right? The bank accounts were paying nothing. Bonds were paying very, very little interest. In fact, I called it, you know, no return and all risk, which is not the combination that you want to have. So, you know, Tina was ruling for a while, and now we have Tammy at the helm, and Tammy's another acronym, and it stands for there are many yield choices. TAMMY, and then a C on there. Tammy C. There are many yield alternatives or choices. And right now, you know, it's not that hard to get about 5% in your bank account, right? CDs, U.S. Treasuries are paying a high interest rate, so there's a lot of choices. Tina has left the building and Tammy has entered, and so there's less incentive to invest in stocks, right? When you can get a guaranteed FDIC insured return of 5%. You know, the stock market's long-term return of 8-9% looks less attractive to you. And because of that, a lot of people are saying, you know what, I'm not going to take the extra risk. I'm just going to park my money in bonds. I'm going to park my money at the bank. And so it puts pressure on stocks. That's one of the reasons there's more competition for stocks, because now there is an alternative. The other thing is, if you think about it, you know, let's say you're going to hold a company for 10 years. And at the end of 10 years, you're planning on selling the company. You think the company is going to do really, really well. They're going to do things better, faster, cheaper. They're great at execution. They deploy their capital well. And so you're thinking, hey, I'm going to hold on to this company. If everything keeps going this way, I'm going to hold on to it for 10 years. And let's say that company doesn't pay out any cash flows, any dividends along the way, right? So, and let's say you paid $100 for this stock, and let's say you're right, and in 10 years, that stock is worth $300, right? So it doubled twice during that period of time. So basically, you know, that would be about a 14% return. If it doubled once, it would be about 7%. So good for you. You got a great return, right? So you invested $100. It doubled twice. I'm sorry. So let's say it's worth $400. It went from 100 to 200, and then 200 to 400. I think I said 300 earlier. I should have said 400. So now you've got that $400, and I'm going to give you two worlds. In a world where inflation during that period of time was 6%, is your $400 worth more in a world where inflation was 6%, or, you know, that $400 in 10 years? Or is that $400 worth more to you in a world where inflation was 2%? I would argue, and the math would agree with me, hopefully, that your money's worth a lot more to you in today's dollars if inflation was only 2% instead of the higher inflation rate. And that's called a discounted cash flow, DCF. And because the value in the future is lower for a future dollar, if inflation is higher, if interest rates are higher, if what's called the cost of capital that you would discount that return at, even though the company in both cases did just as well, and the value, you were right, it quadrupled in value, it doubled twice over that period of time. In a low inflation environment, that's worth a lot more for you. Here, you can hear the train starting to come. You can kind of see it behind me here. Sorry about the noise. I'm close to a very active train line, but you know, that's one of the reasons that inflation can be challenging for stocks. Another reason is you think about a company's largest cost. You know, in a lot of industries, a company's largest cost is its employees. And when inflation is high, employees are saying, hey, you know, I need to keep up with inflation. I want to make more than inflation. I want a raise that's bigger than inflation. So the cost of labor goes up. Certainly restaurants are seeing this, retail is seeing this. We're seeing this across the board with companies. There's a lot of pressure on companies on the labor line. Also rents. A lot of rents have an inflation escalator in them, so the rents go up. Their cost of goods sold, the materials a company has to buy, go up as well. And then the question is, can they pass on that cost, right? So if you have a company that makes something that's discretionary, let's say mountain bikes, and the labor costs and the material costs is going up, well, then the demand for those mountain bikes, you know, I live in a ski town. In the summer, what we do is ride mountain bikes. And I have friends that own mountain bikes that are worth more than my car is. But you know what? That's something that they can put off. They don't need to have the latest and greatest every year. Also vacations, right? So people going to resort towns, there can be less demand for lodging. There can be less demand for ski tickets. There can be less demand at a resort town's restaurants. And at the same time, it's hard for those restaurants to hire people. They're paying more than ever. Their food costs is going up. And their customer is saying, you know, the locals are saying things are getting really expensive. I said, no, we don't have another train coming. Things are getting expensive, so I think I'm going to pass. So not only do we have that discounted cash flow calculation that I talked about earlier, not only do we have Tina, there is no alternative, that has left the house, has left the building. Here's the end of the train here, so it'll get quieter. And Tammy has come in her place where there are many, many yield choices available to people. But then you just have, you know, it's harder to run a company during an inflationary period. All your costs are going up. And unusually in this period of time, labor is also very, very tight. So it's harder to run your business because you have people leaving your company to go work somewhere else because they can make a little bit more money because unemployment's so high. You have inflation that's increasing the cost of your inputs. And you might have a customer that's just not willing to pay that higher price. And so your demand's going to go down. Speaking of demand, if you enjoyed today's video, thumbs for likes, subs for love, and comments for me, Azul. I love reading your comments. And if you have demand for more videos, I know you're going to enjoy this video here, which talks about the average income in retirement for Americans. And this video down here that talks about 5 reasons to retire as soon as you can. Thanks for watching. Bye-bye.